Okay, everyone, welcome back. This is episode 2, and it's a 5-minute structured breakdown of Mayfield East. Mayfield East is just to the smaller suburb to its bigger brother Mayfield, but much superior in my opinion. And the results go and show the same thing. So as you can see here, typical price is close to 1.3 million. Not great rent for this market. Yields typically trading around that 2.5. You can get upwards of 3% in this market, but the last 12 months, 17.5% growth is outstanding, especially with all of the fluctuations with the interest rates. As you can see, only 850 dwellings in this market and 1,800 population. I mean, economic diversity for this type of market, very similar to Newcastle, not surprising there. But have a look at the sales volume and price growth over the past decade. A lot of people have been investing interstate, throwing money into risky suburbs over in Perth and all of these other regional markets to try and capture hotspots. Here you've got a market 2 hours north of Sydney, 7th major city in Australia, really strong economy, and you've just got 175.8% growth over a 10-year time frame. There is consistency there. However, in the past 12 months, having growth of 17.5%, that is getting really up there for this market to continue to sustain that type of growth. I would say that there's going to be a lot of money that flows out of this market into other more affordable neighbouring markets in that Newcastle area. But that's outstanding growth for a 10-year time horizon and outstanding growth the last 12 months. There is a little bit of ebb and flow through there, but it is relatively consistent with its growth. You can see it sort of started to take off here in 2015. Prior to that, it was pretty stable growth, still a slow upward trend. And stocks remained relatively the same. It's sort of decreased a little bit here, which has probably contributed to that significant increase in price. 60% increase in rental incomes in that area. Again, really consistent and much better to the previous episode that I did on Manly, which only had 40% increase in rents. And this looks like quite volatile market in terms of its growth rate cycles, but really every market around this COVID-19 era was very similar. It was very inconsistent. It had this massive contraction spike in most markets. But as you can see here, going back to 2010 to 2017, I mean, even during contraction times, you're still having growth. So 2014, 5% growth the year before. We had 9% growth the year before, 7%. And then 2017, you've got nearly 19% growth. So every single year, even during contraction times, you're still actually making money. So it's just contracting more than what it was growing in the previous years. Like I said there earlier, it is a pretty expensive market for what it is now. There's no spillover potential and there's no short or long-term pattern deviation. So I think there is going to be money flow out of this market into its more affordable neighbouring markets, but we will see where that lands. Socioeconomic score of 7, that's improved over the last decade and obviously contributed to that price growth. Units to houses, you've got basically just houses within this market. So, complement this to demographics. I'm not going to touch on demographics in this video, but if you go and have a look at the demographics occupying this market, it's basically families. Rented to owners. So I would like to see, for such a highly dominant family-friendly suburb, I would like to see more owners in that market to renters. However, there has been a lot of investor money obviously into that market because they were savvy to the fact that it was a good market to invest in. Surprisingly, a lot of 3-bedroom houses dominating this market, which is most likely why those rental figures are quite low. Typically, their older dwellings are only 3-bedroom and a lot of them don't have car spaces, which is why yields are so low in that market. But primary dwellings in that area is 3 bedrooms. If you have the capacity to get a fourth, obviously going to come with a high price point, but you then start to cater to both of those markets for people who only need 3 bedrooms, but appreciate a fourth for a study or just extra storage. Like I said, with that affordability, it is trading in line with long-term averages, so I don't see any short-term upside with this market. Still trading really tight, only 16 days stock is staying on the market, which would be really consistent. Most of them, like I said, 3-bedroom houses trading in that time, really low stock, and clearance rates, not below 1%, but still below 2% is really good. So that's outstanding market for the past 12 months, but we'll see how it trades over the coming 5 to 10 years.